Hi there and welcome to today's webinar. I'm Sophie Lewis, Marketing Executive at Equiteq, and today Ramon Param will be presenting the findings from our latest global management consulting, global M&A report, sorry. He's going to be presenting for about 50 minutes. We're going to do a 40-minute presentation followed by 10 minutes Q&A session. Please post any questions you have using the control panel on the right-hand side of your screen, and you'll find the questions box towards the bottom. So over to you, Ramon.
Thanks, Sophie. Great. So before we start the presentation, just wanted to give a little bit of background on myself and Equiteq. So my name is Ramon Param. I'm an Associate Director in the Market Intelligence and Buyer Coverage team based in Equiteq's New York office. Before joining Equiteq, I started my career at the Macquarie Group's corporate finance business based in London, where I advised on buy-side M&A opportunities and also helped to restructure distressed assets for Macquarie's managed funds. I subsequently joined PwC's corporate finance business, where I was a founding member of PwC's global corporate development team, helped advise PwC's global leadership team on inorganic growth strategies as part of that role, and really focused on consulting M&A, advising on transformational deals like Booz & Co., now known as Strategy and PwC's acquisition of PRTM, as well as smaller territory-focused transactions in the consulting sector. A little bit of background on Equiteq. So we were founded in 2004, following our founder and chairman, Paul Collins' growth and exit of his own consulting business, WCI. Equiteq was founded with the aim of helping owners of consulting firms to grow and realize equity value in their own businesses. And today we offer those services through a strategic advisory practice focused on helping businesses to assess their performance and consider what they need to do to become sale ready, and through M&A services, so helping owners of consulting businesses by carefully managing global sale processes on behalf of their firm. All of these services are laser focused on the knowledge-led services sector, which we break down into 5 segments: management consulting, IT services, media agencies, engineering services, and human resources. And we provide these services globally from a team of over 50 professionals comprising of investment bankers, founder owners, and consultants located in our offices in New York, London, Sydney, and Singapore. So that really gives us a global perspective on the industry and also the buyer universe that are participating in our transactions. So having worked on many highly successful outcomes for clients in our industry, we were pleased to be named this week as the Boutique Investment Banking Firm of the Year by the M&A Advisor. So we're very pleased to receive that recognition. So the Global Consulting M&A Report 2017, so this marks our 10th anniversary of the report, which is a focused review of M&A and equity market trends related to consulting firms across each of the 5 segments of the industry that we cover. The report utilizes various publicly available data sets, as well as proprietary information that we have on the industry to produce the analysis that you'll see in the report. The webinar will look at the report, discuss an overview of M&A activity, typical deal sizes, regional variations, equity market trends, valuations, and also buyer activity across the sector. Before we wrap up after about 45 minutes for some Q&A. So with that background and context, let's jump in and take a look at some of the findings from our latest report. So 2016 was a strong year for M&A across the industry. Volumes rose by just 1% over the year. Median deal sizes rose by over 20%. And overall deal activity, as we can see by the chart to the left of this slide, is now reaching a 10-year high. Now, a lot of that strong M&A activity is against a backdrop of slow global economic growth for 2016. So according to data from the IMF's World Economic Outlook, global growth last year was estimated at just 3.1%. So that's its weakest performance since the financial crisis. And it was also obviously against a backdrop of a lot of political volatility with the UK's vote to Brexit and the US presidential elections. So notwithstanding those restraining influences, deal flow across our industry was strong, and we saw particularly strong activity in management consulting, media, and IT. A lot of the activity was occurring in those three segments, and a lot of growth there as well. And we can see from the right-hand side of this slide, this strong investor confidence amongst buyers of consulting firms was also mirrored by equity market performance. So share prices of listed consulting firms rose rapidly, and there's also strong increases in quoted valuation metrics of listed players that operate in the industry. And we'll discuss that in a little bit more detail and what that means for the M&A market a bit further on in the webinar. Now, industry trends like digital disruption, globalization, geopolitical volatility, with those political events we talked about on the last slide, they're presenting challenges for businesses, but also a net opportunity for many consulting firms to work with clients on reviewing their businesses and operating models. Clients are looking to consulting firms to really offer them end-to-end best-in-class solutions. So that's really driving demand from a lot of buyers to acquire consulting firms that have niche capabilities to meet a lot of that demand that they're experiencing from their clients. Now, we saw particularly strong demand in certain niches of the market. So strategy consulting, saw a lot of activity there. Last year's major deal in that space in the market was Accenture's acquisition of Kurt Salmon's retail business. Regulatory change and compliance, another hot area. Promontory IBM was a major deal in that space. Cloud consulting, continues to be an area where we're seeing a lot of demand, and there was various deals in 2016 in hot cloud ecosystems like Salesforce and Workday. Digital media is experiencing a lot of activity, especially with the rise of the Internet of Things and artificial intelligence, which is transforming customer experience. And within digital media, a lot of activity in the mobile consulting space. Buyers are really looking to capitalize on the shift amongst consumers to use mobile as a first touch point to engage with businesses. And from a sector vertical perspective, we are seeing a lot of demand for healthcare and financial services. So there's a lot of strong long-term market drivers that buyers can see in those verticals, and that's really creating a lot of demand and activity in that part of the market. And of course, strong demand as we saw last year for consulting businesses that are enhanced by advanced data analytics tools. That continues to be a very hot area for activity. Another notable trend that we saw in 2016 was a convergence in buyer demands. And that was evidenced by those two deals I mentioned on the last slide, Accenture, Kurt Salmon, and IBM Promontory. So the table to the left of this slide is a matrix. Along the top are each of the 5 buyer segments that we cover. And so we've segmented the market into the 5 sectors we cover and placed each of the buyers that were active last year into those segments of the industry. And then along the
Hi there, everybody. Sorry, Ramon's just having a few technical difficulties. If you could just hold on.
Outside of their core
Oh,
industry.
sorry, Ramon. We just lost you for about 40 seconds there. If you could go back
Okay.
and just start at the beginning of the slide, that'd be great. Thank you.
Yeah, absolutely. Yep. Apologies for that. So one of the key points on this slide was really around converging buyer demands. So, in addition to a lot of those hot segments that we talked about in the prior slide, we saw a lot of activity with respect to converging buyer demands. So buyers from adjacent industries looking to acquire into other industries. And that was evidenced by the Accenture Kurt Salmon deal and the IBM Promontory transaction that I discussed on the last slide. So on this table to the left of the slide, we show a matrix. Along the top of the matrix are all of the buyers that made acquisitions over the last year, broken out into each of our 5 consulting segments that we cover. And along the left of the matrix are all of the target companies that they're acquiring, broken out into each of the 5 segments of the industry that we cover. And the matrix really is a heat map. So dark red indicates where proportionately a buyer group is acquiring outside of their core industry highly. So we're seeing a lot of dark reds along the top of this matrix. So a lot of the buyers in adjacent industries to management consulting are looking for management consulting acquisitions. This is largely being driven by demand for strategy consulting capabilities, which are often seen as a gateway for buyers in adjacent industries to on-sell their core offering into new industries and markets. There's notable convergence, a lot of red shading we can see at the intersection of management consulting, media agencies, and IT. So what we're seeing here is a lot of buyers are looking to build creative agencies that offer their clients a combination of strategy and media capabilities, along with the latest, with the knowledge of the latest technologies that are disrupting customer experience. So a lot of activity at that intersection, and that was really exemplified by a lot of high-profile commentary which we observed last year from the likes of senior management at WPP and IPG, who both acknowledge that their competitors that they're coming up against aren't just the large marcoms. They're increasingly the likes of Accenture, Deloitte, and IBM. Who are also acquiring in their space, and there's a lot of competition amongst those non-traditional buyers in their industry. A lot of dark shading as well amongst engineering and human resources buyers, looking to move up the value chain by acquiring management consulting capabilities, and also broadening their services into technology consulting. So the overall message from this slide for an owner of a consulting firm is that there's lots of convergence in the industry, and the buyer for your firm that potentially would pay the highest price might not be operating in your core sector. So on the next slide, we had a look at average transaction sizes. So the average transaction size across the consulting sector rose by 64% to $124 million. That was driven by some major deals such as the sale of Alex Partners by CVC, the acquisition of HPE's services business by CSC, and the large merger of Willis Towers Watson. All of that drove, those mega deals really drove high average deal sizes over 2016. But the median deal size was much smaller at $12 million. And as we can see by the graph on this slide, there are a substantial proportion of M&A that's under $10 million in size. And that really represents, a ready source of bolt-on acquisitions for a lower or mid-market consulting firm that is looking to expand its capabilities by acquiring a smaller business. Now, comparing average deal sizes across sectors, we can see that HR and IT, there are higher average deal sizes in those sectors of the market. And that was largely due to some of those mega deals I discussed earlier, which are really upping the average deal size in HR and IT. But these sectors are also very fragmented, as we can see from this chart, really dominated by smaller deals and mergers that occur, which don't necessarily capture the headlines. Now, what we typically observe is that these smaller transactions are consolidated through small mergers or team grabs, usually with little cash involved. So the sweet spot of deal activity where we see a material cash component exchanging hands is really above $10 million. We also took a look at deal structuring as part of our M&A report. As we can see from the graph on this slide, there's a lot of variation amongst the reported deal structures on completed transactions in 2016. The median disclosed deal is highlighted by the blue line, and that saw 58% of consideration being paid up front, and the remainder being paid as an earn-out structured over 3 years. So we typically observe that that earn-out is normally linked to revenue or gross profit targets that normally aren't impacted by the integration of a target business within the buyer's organization. Now, it's quite interesting to have a look at what we found in the M&A reports from this deal structuring perspective with what we observed from our buyer research at the end of last year. So, the average deal here, just under 60% of consideration is being paid up front. According to the buyers that we surveyed at the end of last year, buyers fed back that they are targeting to pay around 45% of consideration up front, with the remainder structured over 2 to 3 years as an earn-out. So it's interesting to see that a lot of the buyers were expecting to pay a significantly lower proportion of consideration up front, but when it came down to it, were potentially paying a higher proportion than they'd ideally like to. And this is something that dovetails with the transactions that Equiteq works on. So here we have a chart which outlines the proportion of upfront consideration across a number of the recent transactions we've advised on. And as we can see, the average here is significantly above 45% and possibly above the 60% that we observed in our M&A report. So what we typically find is that in a well-managed process with a lot of competitive tension from different buyers, there is the potential for buyers to up that upfront consideration they're looking to pay and convert some of that earn-out or deferred consideration into either fixed payments, deferred, or an upfront component. So that's something we do typically see, and really is something that changes during a deal process as you're negotiating with a buyer. Now, moving on to regional variations in the report, we found that deal activity was focused on North America, accounting for 44% of all deals, followed by Europe, accounting for 38% of transactions, and the remainder really focused around Asia-Pac and Australasia. Now, deal activity in North America was down by 7%, with particularly sharp falls in M&A in the period preceding the presidential election. M&A in Europe rose substantially by 12%, and that was largely due to a robust first quarter. Activity fell in the quarter preceding the UK's Brexit vote, but did rebound sharply after that. So overall, European M&A was strong. And we did notice that in the UK it was particularly strong. Completed transactions rose by 20% over 2016. So that possibly indicated that buyers were taking advantage of a depreciated sterling after the UK's Brexit vote to acquire or to up their acquisition activity in the region. There was strong activity in APAC, particularly in Singapore, but deal flow fell in Australia, although average deal sizes did rise substantially, indicating that buyers in Australia were possibly focusing on larger deals rather than making lots of smaller acquisitions. Australia is a region that we're observing a lot of growth, particularly within hot areas like digital and consulting to the energy, mining, and FS sectors. Despite a lot of the political volatility in the year, cross-border deal activity was strong. So over 2016, cross-border deal activity accounted for just under 30% of all deals, and that was slightly up from 2015. The proportion of cross-border M&A rises as we look at transactions from $10 million and up. So that really indicates that this trend of international buyers participating in processes, does rise for larger transactions, and particularly where you've got a mature business that is on sale and can act as a platform investment for an international buyer to fill a capability or to enter a region that they don't have a strong presence in. As we can see from this analysis on the slide, cross-border activity is more prevalent in APAC and Australasia. Mature businesses in developed markets are really looking for platform investments in high-growth regions like Singapore and Australia to really expand their business. But notwithstanding that, there was a lot of activity cross-border in nature the other way around. Having a look at some of the big deals that occurred in 2016, the likes of Wipro, NTT, and Dentsu were, highly acquisitive and made some high-profile deals in North America. These buyers are cash-rich, and they're looking to put that cash to work, especially when it comes to cutting-edge capabilities in these developed markets. So, just pausing there, the overall message from this slide really is that there's a lot of cross-border activity occurring, and for a consulting owner, the right buyer for your business may be global in nature, or may be focused on another region in the world and wanting to acquire your business as a platform to enter your domestic market. So we also had a look at equity market trends as part of the report. So we looked at that through our proprietary index, the Equiteq Consulting Share Price Index. The index ended the year up 14%, well outperforming the S&P, and ended the year on a 10-year high. Now, the strongest subsector index was the Management Consulting Share Price Index. So that was up 14% over the year. So that was up 32% over the year. The overall index was up 14%. So the Management Consulting sub-index really outperformed the overall market. And that was largely due to strong share price increases from the likes of Navigant, FTI, and ICF International, all performing really well during the year. The Equiteq Engineering Consulting Share Price Index achieved strong gains in the second half of the year, really mirroring the recovery in oil prices during that period. The Equiteq IT Consulting Share Price Index also performed pretty well. It grew by 9%. The Media Index achieved more modest returns of 6% after a strong year in 2015. And the HR Index ended the year down, although there was a very strong quarter in Q4 where it achieved very strong gains in comparison to other sectors of the market. So looking at the share price performance overall, a lot of strong investor confidence in the industry from an equity market perspective. Just moving on to valuation trends. So we had a look at pricing and valuations in the industry, and we've seen that they've remained pretty robust over the last few years and continue to remain strong. And that's really been driven by some of the strong industry fundamentals that we talked about at the beginning of the presentation. Low interest rates and a lot of capital for private equity investors and corporate buyers to access to make acquisitions. That's all driving a lot of these robust pricing and demand that we're seeing in the market. In 2016, the average last full year revenue multiple was just over 1x, and the average last full year EBITDA multiple was 8.6 times. Now the metrics on deals, as we can see from this bar chart, was particularly higher in management consulting, media, and IT. And all three of these industries were where we saw the most activity from an M&A perspective. So possibly indicating that these valuations are being supported by some of the competitive tension amongst a lot of buyers trying to do deals in these areas of the market. Now, it should be noted that that these figures that we do report in our M&A report, they are reported valuation metrics. So they are unadjusted, they are historic, so they should be really treated with caution when you're trying to apply them to the valuation of your own business. It's really important there to get professional advice to help you better ascertain what the appropriate adjusted market value of your business will be. Really treating these figures with caution and really as comparative guides when you're looking at pricing your own company. So we looked at M&A valuations, but we also had a look at the valuations of quoted companies that operate in the industry. So what the quoted valuations of listed businesses like Dentsu and FTI are, and how they performed over the last few years. And as we can see by this chart, listed valuations have been rising over the last few years. And this year, the average last full year revenue multiple for a listed consultant rose to 0.8 times, and the listed last full year EBITDA multiple rose to just under 10 times EBITDA. So, what we're seeing is listed companies enjoying, rising quoted valuations, also rising unused cash balances, which I mentioned earlier. So, their ability and also their demand to make acquisitions is rising. And we're seeing that through a lot of the pricing amongst these listed buyers when they're looking to make deals in the market. They are looking to pay premium multiples. And they can do that by making, still making an earnings accretive acquisition by paying a small discount to their already premium earning ratios. Now, if we flip to the next slide, we can see that serial buyers of consulting firms, those that have made multiple acquisitions over the last few years, were responsible for a large proportion of activity over 2016. So in total, a serial buyer made 46% of all transactions in 2016, and that was up on the prior year. And as we can see at the bottom of the table, really reinforcing the message from the prior slide, the vast majority of those top strategic buyers are listed players, of the likes of Huron, Accenture, Dentsu, NV5 in engineering, and Arthur J. Gallagher, all listed companies predominantly enjoying increasing share prices. Dentsu was the most acquisitive buyer across the consulting sector. They really stepped up the rate of acquisitions in 2016 and overtook Accenture and WPP, who were named as the most acquisitive buyers in 2015. The main acquisition that Dentsu made was their acquisition of Merkle, and that was a very notable deal in the digital media space. Merkle's the largest independent US-based agency focused on CRM and search. It has a vast data set of first-party customer records, and a really strong relationship with the likes of Google and Facebook. So it's seen as a prize asset in the market and a major acquisition for Dentsu. Dentsu also made a number of other smaller deals across the digital media space. So in total, it acquired 25 businesses, mainly through its international arm, Dentsu Aegis Network. Dentsu is really looking to expand this part of its business following its acquisition of Aegis in 2012. And really this is part of a drive to reduce its dependence from its Japanese home market, which has been performing more sluggishly in comparison to its international revenue streams. Accenture continues to be the most acquisitive buyer within IT services, particularly focused on acquiring niche capabilities in disruptive areas of the market. So it acquired a number of cloud services businesses focused on established cloud ecosystems like Salesforce, Workday, and ServiceNow. It also made a number of cybersecurity acquisitions. So Accenture bought Redcore in Australia and a business called Maglan in Israel. It's also interesting to note that Accenture are broadening their capabilities into adjacent industries. So they're acquiring in areas like strategy through their acquisition of Kurt Salmon, and also looking to expand into advertising, and that was notable with their acquisition of Karmarama in the UK. Accounting firms continue to be notable acquirers in the consulting industry. And as we can see from this chart, they made a number of acquisitions in 2016. But the Big Four in aggregate did slow down their rate of new deals over the year. And that was particularly so in the United States. And what we're seeing is a real focus amongst some of those buyers to integrate and enable synergies from some of their recent acquisitions in the region, and take a possibly more selective approach to acquisitions over the next 12 months. Nevertheless, there is still a lot of activity from the Big Four. So we saw PwC acquiring businesses across its network, with notable acquisitions in the UK and Germany, and also in Central and Eastern Europe. Deloitte was also particularly acquisitive in IT services and in disruptive areas of the market. And we also saw a lot of activity from BDO. They really upped their acquisition activity in 2016 and made a lot of acquisitions in the US. So they made 7 accounting and consulting acquisitions across the United States, as well as acquisitions in areas like business advisory and cybersecurity across their EMEA network. Now, as part of our buyer research that we published at the end of last year, we talked a lot about private equity buyers who are strong investors in the consulting sector and really do offer, a flexible solution for a consulting owner that is looking for options outside of a full exit to a strategic acquirer. Now, private equity accounted for around 6% of all acquisitions in 2016. And that was in line with what we've seen over the last 10 years. So that's a stable and strong proportion of activity from private equity investors, despite some of that competitive pressure that they'll be facing from those aggressively active listed strategic acquirers that we talked about earlier. Now, what we're observing is that private equity investors are active. They've got a lot of dry powder that they're looking to put to work, and they're becoming increasingly comfortable about doing acquisitions in the consulting sector. So when we had a look in our buyer research at some of the multiples that private equity were targeting for acquisitions in the industry, we saw that they were actually at a premium to strategic acquirers that we surveyed. So that really indicates a willingness to pay premium multiples for those acquisitions that they really want to do in the industry. What we found from the data on reported acquisitions is that the proportion of private equity involvement does increase as we look at transaction values at a larger size. So as we can see here, as we look at deals from $10 million and up, the proportion of private equity involvement increases substantially. What we found is that at the upper end, there was a lot of landmark consulting acquisitions undertaken by notable private equity investors, like the sale of Alex Partners by CVC to a consortium led by CDPQ, the divestment of Carlyle's existing stake in Booz Allen Hamilton, the acquisition of Optiv Security by KKR. You know, all of these are notable acquisitions across the consulting sector by some big names, and a lot of substantial activity in the healthcare analytics space, a segment which is really benefiting from healthcare reforms from the Affordable Care Act in the US, and also underpinned by a lot of long-term market drivers. You know, an industry which is undergoing a lot of change and is of real interest to private equity investors in the space. So, you know, we expect that a lot of these successful deals, particularly where they're being marked by some of these substantial returns that we can see on this slide, they're going to have a reaffirming effect on, you know, financial buyers' involvement in the industry. So we're expecting that to underpin, you know, a lot of private equity interest in the sector as we look over the next 6 to 12 months. Great. So wrapping up and in conclusion, 2016 was a strong year for deal flow in the industry. We're seeing a lot of the momentum over the last year carry into 2017, and that's been evidenced by strong rises in consulting share prices, and also some major deals across all 5 segments of the market in the first half of 2017. Along with some major plays by private equity investors who are continuing to make investments of notable businesses in the industry. Another interesting development, you know, over the last 6 to 12 months are the continued advancements in partnerships in hot areas like IoT and artificial intelligence. You know, as these announcements are being made, we're expecting that a lot of the consulting firms with cutting-edge related capabilities are going to benefit considerably and see a lot of interest in their firms. So these, you know, overall robust market trends gives, you know, owners of sale-ready businesses a lot of options to consider as they look to exit their business over the next 12 months or further afield. So that concludes our presentation today. So I'll hand over back to Sophie for some Q&A.
All right, that was great. Thanks, Ramon. So we've got a few questions that have come in. I'm going to start with one about deal structuring. So this person writes, what things might up the upfront part of consideration if I received an offer?
Okay. Great, thanks for that. So there's probably a mixture of things that will impact, you know, a deal structure during a transaction negotiation, and you know, some of those things aren't necessarily in an owner's control. So a lot of it will be due to things like a buyer's risk appetite. You know, if a buyer is more risk averse, they're likely to require more cash to be paid, you know, really as part of a deferred component or as part of an earn-out rather than putting it up front. Also, some buyers that are listed or private equity are typically going to use earn-outs more so than other buyers in the market. So, you know, the nature of a buyer will impact sometimes the deal structures that you will have on a transaction. But there are also things that are in an owner's control that they can think about during the process. So, you know, running a process where there's a lot of competitive tension between different parties, that's always going to, really influence not only the valuation of your business, but also the deal structures that you'll be getting. Buyers will be looking to pay more upfront to make their deals more compelling to an owner looking to sell their business, if they know that there's other competition that are also being reached out to. Also, I think there's ways that you can look at mitigating risk in the eyes of a buyer, ensuring that as you're working on developing your business, your revenue is diversified amongst a lot of different clients. You're developing intellectual property like methodologies and tools that reduces people dependency risks. You're looking to align incentives amongst key members of staff. All of these things will reduce risk in the eyes of a buyer and are likely to increase valuation and also increase that upfront component as you're entering negotiations.
Okay, thanks for that, Ramon. So the next question, this person owns a cybersecurity business and they've asked, they're in initial discussions with a PE firm, but what things should they be considering in their negotiations?
Great, yep, Naked. So, we mentioned private equity being very active in the sector, and I think that was evident by a lot of the data we saw in our report. I'd say that cybersecurity is a segment that we're getting a lot of demand in, amongst financial and also strategic buyers. And that was obviously evident by larger acquisitions in the market, like the acquisition of Optiv Security over 2016. I think when you're in discussions with a private equity firm, the sort of things that they're looking for are, consulting companies that have a strong market position. That's important. A clear value proposition. Usually, a diversified client base. Intellectual property is seen as something that's very important to private equity as it reduces that key man dependency risk. And another thing, very important to private equity firms is, repeat or recurring revenues. So wherever you have long-standing relationships, or any managed services revenues, that's going to be important to be highlighting that to a private equity buyer, as they're going to be attributing a lot of value to that. So, thinking about those sorts of aspects of your business in the eyes of a private equity firm, making sure you're articulating that, and that will put you in the best position as you're negotiating with them.
Thanks, Ramon. So third question, my business generates less than 10 million revenue. Should I then be discounting a PE buyer?
Great. Yep. So that's a good question. We did have a look at some of the data during the webinar on the deal sizes that private equity are typically involved in. And below $10 million, there is a substantial reduction in private equity involvement in the sector, and I think that's particularly so for standalone investments. Private equity, most of the mid-market private equity firms that we speak with, they are looking for businesses that have at least $10 million of revenue. But what my recommendation would be to a company that is below that would be, if you are looking to position yourself as a standalone investment, look at opportunities to grow your business, above that threshold, and whilst you're growing it, think about those things that I discussed earlier around intellectual property, around diversification of clients, to put yourself in the best position when you do start negotiations with a private equity firm. But if you're looking at a more near-term opportunity and you are smaller, I think probably your best option would be to consider bolting your firm on to an existing platform investment at a private equity. So where we do see those size thresholds becoming less meaningful is where a private equity firm has a relevant portfolio company that they're already working with, and they're looking to expand. and then they are looking for, capabilities that are much smaller in size. And then, there is a good opportunity then to get private equity involvement in your business.
Okay, so the next question, I'm going to move away from PE. This one's on hot areas. So this person asks, my business isn't in a hot area that you presented on. Does that mean I can't sell or couldn't sell?
Yep. Okay. So we touched on a lot of the areas that are getting attention in the M&A market over the last year. So talking about areas like digital and cloud, cybersecurity. A lot of these areas are high growth. There's a lot of demand for businesses in these spaces. But having a look at our report, having a look at some of the precedent deals that we talk about at the back of each of our segmental analyses, you will see a lot of traditional consulting firms that are also being sold at good valuations. So I think a lot of it comes down to if you have a solid business with a unique proposition, you've got a strong client base, you've got leverageable IP. All of those will help you to be in a good position to sell your business, even if you're not in a hot area that is going to be getting a lot of those premium valuations in the market. So I think really the point there is that if you're not in one of the hot areas that we talk about in the reports or we've spoken about in this webinar, that doesn't discount you from a sale. There still will be options out there for you, even if it's not at those sorts of valuations that those digital consultants and some of those other fast-growing areas of the market are achieving.
Okay, so we're coming to the end of our 10 minutes Q&A session. I think we've got time for one more. I'm going to choose this one. It's based on location. So my business is based in an obscure part of the country. Will that impact sale?
Yeah. So I think when we do look at transactions in the market, and also from our own experience of selling businesses, there are sometimes premiums that are attributed to companies that are focused on hubs, like New York or San Francisco in the US, or London in the UK. And sometimes we do get feedback from buyers that they are looking for businesses that are working in those sorts of locations, and where they're likely to have access to some of the bigger clients that they want to work with. But notwithstanding that, there's a lot of examples of firms that we've worked with, and also a lot of transactions that we highlight in our report, where they're not operating in those sorts of locations, and not even operating in countries which are necessarily hot for consulting or M&A. And in those regions of the world, you might be limiting some of the buyers that will be looking at your business, but there will be enough buyers out there that will be interested in your company if it's got a strong value proposition, and it does hit a lot of the metrics that they're looking for. And I think that's been evident from a lot of the processes that we've run, where we've had companies that are located in obscure locations, but we do get interest from a whole host of global buyers, as well as regional players that are looking to expand within a specific region. And where it comes to the global buyers, sometimes they might have exhausted a lot of their growth in their existing locations, and are really looking to expand by acquiring a company that's operating in somewhere new. So I think the short answer to that really is that it doesn't discount you from a sale. It might limit some of your options, but there will still be buyers out there if you have a quality business that will be interested in an opportunity like that.
Okay, thanks for that, Ramon. So for those of you who sent in questions which we haven't had a chance to get to, Ramon's going to come back to you after this webinar. Also, for those of you who've asked for a copy of the slides, I'll be sending you an email after this webinar with that. If any any of the rest of you would like a copy of the slides, or you'd like to talk to me or talk to one of our deal leads, then you can get in touch with me at sophie.lewis@equiteq.com. Also, if you're not already a member, I'd just like to remind you about our Equiteq Edge Club. So it's this free source of information that helps consulting firm owners realize equity value in their businesses, and we update this regularly. You'll find expert guidance, our unique articles, all our publications, a monthly newsletter, so please do sign up. And I just want to say thanks to Ramon for presenting today, and thanks for everyone for dialing in. We'll be sending a copy of the recording within 24 hours to you, and it will also be put up on our website and our YouTube channel. And just to note, the next webinar will be on the 19th of July, and it will be about making a success of succession. So you'll be hearing about that very shortly. Thanks very much, everybody.